So we were wondering, and our questions have been answered. The Fed reduces rates by 50 basis points. We're going to talk a little bit about that and its implications, some ways to trade that potentially, and talk a little bit about the home builders today on Open Interest. Hello everybody and welcome. I am Mike Coe. Welcome to Open Mic, where we're going to take some questions and talk a little bit about this most recent development. So the Fed is coming out blazing. I think a lot of pundits at least had been talking about a 25 basis point cut. Obviously we know that Elizabeth Warren, who shouldn't have a say in this, but that didn't stop her from trying to offer one, wanted a 75 basis point cut. We don't want politicians weighing in on monetary policy, although their presence is ever felt. This is interesting, particularly in the context of the market behavior that followed that announcement. So a couple of things. Number one, I would say don't fight the Fed. This is a lesson that everybody is probably already familiar with. But what is interesting to me is that they believe there was some reason for concern, reason for aggressive policy action. I would describe this as aggressive because much of what the Fed does typically is, respectfully, it's jawboning, right? So 25 basis points, 50 basis points, are these hugely meaningful numbers, one versus the other? No, it's really more about the signaling of what they're going to do in terms of a policy response. And they're signaling that they're going to be aggressive. Now, in fairness, any student of Fed history would be able to tell us that the Fed has historically been always late to the game. They've been late to act on the tightening side. They've been late to act on the easing side. And I think that's one of the reasons why they're trying to be reasonably aggressive here. So what caught my eye, of course, is the same thing that caught all of your eyes, I'm sure, which is that reversal that we got at the end of the day. And the other thing that caught my eye was the correlation between equities and gold when that happened. So as I indicated earlier this week, I still believe that the overall trend for gold is higher from a fundamental point of view. What I was talking about on Monday was actually just a little bit of technical exhaustion, but today's price action sort of bears that out a little bit. Normally, we wouldn't necessarily expect to see such strong correlation between, and you know what, instead of just discussing it, why don't we just show it? So this is what I'm specifically referring to here. Oops, that is some nice typing. Okay, so here we have the price action of the S&P futures. And we'll just add the gold futures to it. And we can see that these two were tracking quite closely through the announcement. I'll just shorten this up a little bit. So we can see that gold was basically just sort of grinding sideways into it. Equities were slightly higher. Both spiked on the announcement. Then they diverged very briefly. Equities caught a bid, caught back up to gold a little bit, and then both sold off towards the end of the day. I think part of what's going on here is a little bit of concern that, the Fed's policy action being aggressive is a response to an economy a labor market that is arguably a little bit weaker than they had hoped or anticipated. And so thus, they're trying to come back with a stronger policy response. With gold, I have to say that there's a couple things. As rates go lower, particularly if they go substantially lower, that's bullish for gold. And you combine that with other types of uncertainty, lack of faith, shall we say, in basically our political institutions and in our fiat currencies. That kind of thing creates support for gold. And of course, lower rates could potentially hurt the dollar, weaker dollar, stronger gold. So this positive correlation I thought was rather interesting. Something to keep an eye on. Doesn't really change my thesis for the trade that I laid out on Monday though, which was buying longer dated call options. and selling nearer dated strangles against it to collect some premium, because I think that that story still remains basically intact. Okay, so I wanted to try to grab a couple questions here, because I thought, so first things first, there was a question posted in, not in the live stream chat, but because I'd asked if somebody had a question about a stock, please put it into the chat, and we did get one. It was about Toll Brothers. So tomorrow we have Lennar earnings coming out. Home builders also hit highs today and then also reversed afterwards. So we've got Lennar reporting tomorrow, and we have, when does Toll report? So Toll is, so they reported on August 20th, and their next one's not until, wow, is that correct? December? Okay, so the question was whether or not I favored, and let me see if I can just quickly find this, by the way. I'm going to, because we can't put it on the screen, but I'm just going to see if I can find the question. And then we will move on to the live stream questions very quickly. So bear with me for just one moment while I get this. And let's see. Okay, so the question was, am I going to be able to see it? Oh, it is. Oh, there we are. Oh, great. Thank you. You got brilliant. The people who are producing this show are very good at their job. So, which of the following put credit spreads on Toll do you like better? The October 152.5, 139, or the November 1st, 152.5, 138? Thanks. So generally speaking, I favor shorter dated when it comes to credit spreads or credit trades in general, because decay typically will accelerate a little bit as expiration approaches. But why don't we just compare these two and see which one we prefer when we look at them side by side. So I'm just going to put this in here. We're going to sell the November 1st 152.5 puts. And then we're going to buy the 138s. And we'll put that right here. Again, I'm just going to use mid-market, so collecting 535-ish credit on that. And if we look at the October 25th weeklies, so we'll just bump that 1 week shorter, and you have the 152.5, 139. Oops, that should be a sale by 139. I didn't need to flip that many switches. Could have just, was a more efficient way to do that. Okay, so 152.5, 138 for November versus the 152.5, 139 for October 1st. Well, just a couple quick things to think about. The first is that in both cases you're selling the 152.5 puts. So, and it's a credit put spread, so you're short the higher strike put. In the case of the October one, you're also collecting a higher premium. So, at least according to this, mid-market. That's probably not true. That is probably just a function of closing market prices screwing us up in, sort of that mid-market. But all else equal, since when you're selling a credit spread, your objective, assuming it's an out-of-the-money credit spread. So if you sold an in-the-money spread, time is not, where both strikes are in the money, time is not on your side. If you sell an out-of-the-money spread, time is on your side. So just an important caveat here. But the stock's 150, so it's mostly out of the money. In both cases, you're selling an in-the-money 152.5 put. But if these prices were accurate, that you could collect 592 for the October 25th and only 535 to trade the November 1st, well, it's clear, right? You would obviously prefer to do the shorter dated one because you're collecting more money in a shorter period of time, which is always better than less money in a longer period of time, all else equal. And notice also that in this example, the the put spread that you're selling, the Octobers, is actually a tighter spread. So this is not, the closing market prices are clearly throwing us here because this shouldn't exist. So I'm sure that it does not exist. And there's something anomalous going on in the pricing data here. But all else equal, I would prefer to sell the October 25th. So if you happen to be using options play right now, or probably in your own brokerage platform, or you're doing any kind of middle of the market pricing, there's obviously some bad pricing data in there. We can probably actually see it if we take a look at the prices. We'll quickly see where things are going wrong. It's probably just a very wide spread or something like that. So we'll go out to October 25th, and we'll just expand the number of strikes here. Yeah, I mean, these things, you could drive a truck through these, right? So this one's $2.40 wide. 139s are, well, those are only 35 cents wide. And the Novembers, 152.5s are 80 cents, and the 138s. Yeah, so that's what's happening, is that we're getting some bad prices. But all else equal, I prefer the October trade. It's a tighter difference between the strikes, so the total amount of risk that you would be taking is, well, $1 less relative to, the amount of premium that you're taking. But, you're going to have a faster decay, so that's an advantage. But it's fairly clear that you're going to want to watch your limit orders as you do this. So I hope that helps. Next thing that we're going to talk about, and actually there were some questions about this, but actually I was going to talk about this anyway, because one of the things that was discussed on an earlier live stream, and you'll forgive me, I don't know whether it was Monday or last week, but the question was asking whether one should buy TLT because of the rate cut. And you may remember, those of you who watched, that one of the things I said at that time was, when short-term rates go down, that does not necessarily mean that long-term rates go down. In fact, very often long-term rates go up, because as short-term rates come down, that would be more inflationary, and it would also spur more growth, higher inflation, higher rates at the long end of the curve. So it's a steepening impact, when a more magnified steepening impact than just the short-term rate cut would imply. So in other words, you make a 50 basis point rate cut, in basically overnight and short-dated rates, you could expect long-dated rates to go up, which means that long-dated bonds go down. And in fact, that is precisely what happened, which is the reason I thought today would be a good day to bring this up and just sort of explain what it was I was saying. And we can see this because I think the long bond lost something like 1%. So we can see that there was some people trading into it here. And I think it was it may have been earlier this week or middle of last week, that somebody was talking about, oh, do I buy TLT? And then take a look at what happened to TLT today. Short-dated rates went down, and the long bond lost 1.24%, which is quite a move, right, for a risk-free asset, which is obviously not risk-free, something that we all witnessed as the long rates went up and long-dated treasuries lost about half of their value as that occurred. So that was the point I wanted to make about that. Now, after I was going to make that point, I then noticed that somebody actually made this point that they were interested in. Okay, here we have it. So Corey Henderson says, Gunlock, he's referring to Jeffrey Gunlock of Double Line, based in Los Angeles. He's the former TCW fixed income manager who sort of has displaced, arguably, Bill Gross as the bond king. Bill Gross would argue that he managed considerably more money. I don't know that that's necessarily the metric. The metric I'm most interested in is performance, and Jeffrey Gunlock's investment performance has been exceptional, and he manages plenty. Basically, he got into a little spat when he was at Trust Company of the West. Very funny story, actually, because he knew he was going to get fired, and he ended up walking out of the building and down the block, knowing that some people were following behind, and he was on the phone, I think, with his lawyers. And Howard Marks, who is the founder and CEO of Oaktree, he got on the phone with him, and Howard Marks said, leave those bums behind, and I'll back you. And that was one of Howard Marks' better investments, because DoubleLine is a huge success. And that made Jeffrey Gundlach $1 billion+ personally, just his equity in that business. Anyway, he is one of the most highly respected fixed income managers. He's a very interesting guy, interesting story, and intelligent, thoughtful, and contrarian in many cases, which I think is good, and he doesn't pull his punches. He said yesterday his firm was short long-term Treasury and long short-term Treasuries, and said it was working and believes it will continue to work. And so then the follow-up question is, how does one put that on? So, first things first, as we can see, if you're going to be if you're going to be short long-dated Treasuries, shorting TLT is a very effective way to do that. And if you're wondering just how effective, I'm going to just expand this chart out a little bit, and we're going to take a look at what TLT can do when it gets on a longer term sort of bear market run. There you go. So that is TLT from 2020 to present. Now that's not total return, by the way. This is just the price. But don't forget, when you were selling long-dated Treasuries, if you did at that high, you weren't paying a big coupon. So the carry on the short position was not that great. So just a quick point, by the way, when Treasuries were there, and I think I wasn't really doing this live stream then, but I may have mentioned it in other contexts. I think I wrote about it. It's interesting because my thinking at the time was that folks should consider selling long-dated corporates in an ETF such as LQD. Now, the reason that I had, now this was not a better trade. So, full disclosure, my idea on this was not a better trade than selling TLT. Obviously, this trade worked out, but it wasn't as good. What was my thinking at the time? So my thinking at the time was that as long-dated rates went higher, obviously that was going to drive bonds down. LQD had reasonably long duration, nowhere near the duration of TLT, which is 20-year plus Treasuries. But the duration of LQD in corporate land is, like 7 to 8, something like that. But my thinking was that if you take a look at the constituent holdings, the holdings inside of LQD, you found a lot of the lowest grade of corporates. So there was a lot of AT&T in there, for example. So we can see that, AT&T. In fact, I'm actually going to put that AT&T in here. And AT&T at the time was BBB-, so it was the lowest grade of corporates. And my thinking was that if rates went higher and you combined that with a weaker economic environment, so you have higher capital costs, weaker economic environment, that it could actually pressure, and I think over 50% of the LQD ETF is actually the lowest tier of investment grade credit bond. So my thinking was that it could potentially push them, some of that, into the highest speculative grade, junk, as sometimes people will call it. And my thinking there was that when you have large funds, like LQD, that then by their mandate can no longer hold that paper, that combined with recessionary fears, combined with other risks, would actually cause credit spreads to expand. And the combination of rising long-dated rates and widening credit spreads, I thought would actually sort of be like a second gear to the short in LQD. But really, it just turned into a duration bet, right? So that ultimately was the thing that mattered most. And if you're playing it on the duration side, TLT is the way to do it. And the other nice thing about trading it, by the way, is that bonds don't have very high volatility. So the options premiums are typically not that great. You are going to want to, because of this sort of carry aspect, so I think I've mentioned this before, higher dividends, you're going to have more carry, and that's going to increase, on the short side that is going to increase the cost of puts, all else equal. So, and also, if this does happen, it's not like an equity situation where you suddenly get a big, crack and what we call price jumps. You're not going to get a huge price jump. You're just going to have, as rates rise, TLT falls. And it's going to be fairly steady. And in fact, we saw that going back to 2020. That was the path. It's going to follow rates. It's going to follow it steadily. There's not going to be huge price jumps. So the way to play that then on the short side would be to use put spreads, because the put spreads are going to help offset some of that carry cost. And that carry cost is just the coupons. It's the bond coupon. So if you have a stock like AT&T, which pays big dividends, you want to short it. Well, if you're short the stock, you're not collecting the dividends, but you owe those dividends back. So that becomes a part of the carry cost of the trade. Same thing when you short a bond ETF, right? So the coupons are distributed as as a dividend effectively to the ETF. So use, in that case, put spreads. That helps mitigate it. And besides which, as we just pointed out, it's going to be a trend trade, not a gap trade, right? So, if you're looking to do something like this, and also because of that, because it's a trend trade, you don't have to worry about, oh, surprise, earnings were better than expected. There's no such thing. If rates go where you believe they are going to go, which is if you believe that the long end of the curve is going to go up and the short end is going to go down, then there's not really a bunch of catalysts other than some wild economic event that's going to throw that. So this is really what you're going to want to do. Buy a put. You could even buy one that's in the money or slightly at the money. And you probably want to do something fairly tight because, as I said, this is trend driven. You're not going to get big gaps. You're just playing for steady movement. So the pars are 315, 95s are 118. So you're paying $1.92 to make that bearish bet. The downside break even on a trade like this one, I just happen to be going out to December. You might be inclined to go a little bit further, perhaps into the new year, to make that play. But the downside break even on this is 98 and change, close to 98 and a dime. That's about $1.50 lower than where it is right now. And oh, by the way, it dropped $1.25 today alone, right? So that's for the short side of the trade. So then on the long side of the trade, you can look to use a shorter dated Treasury, so 1 to 3s, something like that. This is the iShares 1 to 3 year Treasury bond ETF. And this thing was basically flat today. Now, you could, of course, think about, getting into, buying calls or buying call spreads or something like that. But actually, I guess my question would be, why not just buy the ETF? Because you're going to be collecting a positive yield on that. And that'll help offset some of, so the longer dated bearish bet on TLT, and as we have seen, when it does start to move, it can move by large amounts. The decay is not going to be huge, but it's going to be there. So why do you want to be long premium on both sides of the trade and paying decay? Because if anything doesn't work with your trade idea, effectively, you're paying and on both sides. Whereas if you simply bought some SHY and then also bought put spreads on TLT, at least one side has a positive carry. And not a big carry, but a positive carry, and the other one's got a negative carry. It's partially offsetting. And TLT is going to swing around a lot more on rate changes than the short-dated paper will. Okay, so hopefully that makes some sense. Interested in trades for IWM or any other small caps? This is from Greg Forrest. Well, as I've previously pointed out, to me, IWM, the Russell, the small cap stocks are, to me, what I was describing, and others too have described it this way, as the Trump trade. I think the consensus is, and probably most viewers will agree, that small businesses would view Trump's policies to be, more small business friendly. And, I would say also that the rate situation that we're getting here is also one that is favorable, even if the economic backdrop isn't so favorable. Smaller businesses, such as those within the Russell 2000, they tend to, as a size of their business, they are more dependent on borrowing. They have higher capital costs in general, so they tend to be much more sensitive to these things. And I think you kind of have to trade the Russell a bit as you are trading Donald Trump's polling numbers relative to Kamala Harris. If his polling numbers improve, that's positive. If not, not so much. On that, and I have generally tried to steer away from some of the political conversation, but it's getting harder and harder to do that. And part of the reason that it is harder to do that is because when they start opening their mouths and making pronouncements that have some economic impact, when they start making pronouncements that have, for example, tariffs. If Trump says we're going to impose tariffs on all imports, that is inflationary. And not inflationary in the same, it's sort of step change inflationary, basically because obviously globalist trends, the trends of globalism, have been one of the headwinds for inflation for years. As more and more production moved to China to the lowest cost, we were able to engage in a lot of other things that would have been significantly inflationary were it not for that. In several ways, right? So it helped keep the cost of goods down, and then we were able to keep rates low because of that, and that spurred the economy, and that sort of spurred their economy, and we developed a very large trade imbalance. And for a time, when you have that huge trade imbalance, all of the dollars we pay have to be allocated somewhere, and where they often got allocated was into things like U.S. Treasuries. And that excess demand for U.S. Treasuries, so there was a sort of a circular thing going on here. That, they would produce more goods, the cost of those goods would drop, we would pay them in dollars, those dollars would ultimately flow into long-dated bonds, and that would help create a bid under the long-dated Treasuries. So there was sort of this virtuous cycle. I don't know about virtuous. Virtuous means that it was a good thing, and I'm not necessarily sure that in the grand scheme of it we would think of it as being good. But it did create sort of a virtuous cycle that sort of perpetuated itself as a relatively low inflation environment. Now we are seeing several things that are acting in reverse on that. Number one, for those things that we do have to borrow to purchase, borrowing costs not enormous, but in the context of the last 15 years, as high as they've been. we've been seeing onshoring. So companies have gotten increasingly concerned about using China exclusively for manufacturing, and with good reason. China is not always the friendliest place to have a business, as some of their biggest business people have learned. When you set up one of the most recognizable companies in the world, as Jack Ma did in Alibaba, and then suddenly you're not seen for weeks to months, one begins to recognize that, hey, it's not entirely risk-free to do business here. And so I think we recognize that. So there's a number of reasons why we would see less manufacturing and things going on there, but that's going to be inflationary. And then you start tacking tariffs onto that, and that's going to be more inflationary. And the virtuous cycle, again, that's just a convenient way to think about it, that cycle gets broken, right? So I think that's just something to think about. And we have to pay attention to what these folks are saying if we assume that they feel like they have a mandate to enact their promises that they're making on the campaign trail. The next thing is, are the promises that they're making on the campaign trail telling us anything about what they truly believe based on their inside polling numbers, their chances are? So when I start seeing politicians pandering to specific groups, and generally speaking, it's not usually the Republicans, and I'm a registered independent, so that doesn't mean I'm independent on all issues. I'm just saying I've always been a registered independent, and I don't necessarily adhere to the sort of tribalism idea. But I will say this, and that is that in general, Republicans haven't pandered as much to the electorate. And one of the reasons they're not pandering as much is because they're not making promises that we're going to give you this or give you that. More often than not, they're saying, we don't want to give you this, we don't want to give you that, we want a free market, we want less state involvement, we want to have lower taxes, we want to be business friendly, and we want people to be, as Milton Friedman said, free to choose. And so generally, that means less pandering, because if you're going to do that, you are not going to be able to say, we'll pay off your student loans. Haven't bought a house? We'll give you the money for a down payment. Those types of things. Things that cost money and actually are government handouts of one form or another, that's typically come from the left. And the reason I bring this up is because, the tax policy most recently proposed by Donald Trump, which is that he would not impose taxes. He would not impose taxes. It's not up to the executive branch to make these kinds of unilateral decisions, but that they would not tax overtime. And the reason that's interesting to me is because that is a targeted, and it is kind of a handout. If you say I'm going to lower taxes for everybody, that's not a handout. We're saying you earn money, you keep more of what you earn. But if I say, out of A, B, C, and D groups, A and B, they don't have to pay taxes, but C and D do, well, that's more targeted. And that is not simplifying. It's not level playing field. And I can understand the thesis. You can kind of hear it in the rhetoric that gets discussed around it. And that is, these are amongst the hardest working. Well, okay, that would seem reasonable. It seems reasonable to suggest that people who collect a lot of overtime may be working more hours than people who do not collect a lot of overtime. But that's not always true. Ask any 2-year investment banking analyst how many hours they put in. They're not collecting wages by the hour. They are salaried employees, and they put in 80, 90, 100-hour work weeks. Back in the day at DLJ, Donaldson, Lufkin, Jenrette, which was an investment bank that doesn't exist as a standalone anymore, but that was one of the better-known boutique investment banks back in the 1990s. And as it happens, I worked with a lot of former DLJ people, and they believed that you could put in more than 100 hours a week if you were a 2-year analyst. They actually had a very famous memo, and it was distributed at the firm that I worked for by a lot of my colleagues who were former DLJ employees, that said if you're not putting in, and I believe it was 118 and a half hours per week, you have the capacity to take on more work. No joke, that was a memo that was sent out, and I was one of the people that received it. And I went to the guy who distributed it, one of the managing directors and the big PM at that fund, and said, that's 3 full-time jobs, 120 hours a week. So they were saying 118 and a half. They had a little worksheet there. I said, I'm only going to get, at best, if I go straight home and sleep 5 hours, that's all I'm going to, that's the best I could do. And he said, that's all you need. So I guess my point is that somebody in that situation would not benefit, despite the fact that they aren't even sleeping enough, because they're salaried. And so, it brings in questions of fairness, it introduces issues of complexity, and it creates distortions. But it creates some business distortions, some of which could be positive and some not. It adds flexibility to a business that has a big hourly workforce, because one can assume that the workforce, knowing that they would keep much more of the excess of, so you get more money, time and a half or 2 times or whatever it is for your overtime. Time and a half is the standard, but there are some places under union contracts that get 2x. So you can imagine if you're making $30 an hour and it goes to $45 an hour, but that 45 is untaxed, well, employees are going to be lining up to get that overtime. So from the perspective of companies that employ a lot of hourly workers, the fact that they're going to have an existing workforce that is queued up to put in additional hours on demand if called on to do so is probably a positive for them. And so that creates for us as investors something to think about. So now we've got to go think about, all right, well, how many of these companies are out there? Which ones are going to benefit? Which ones are not? Will companies that have larger amounts of salaried employees transition them to hourly so that they can take advantage of the tax benefit? I mean, it's a big mess. But the other point I would make about it is that we should also use that as a trader's tool. You're sitting, or think about the Susquehanna traders. They all sit around and they learn to trade by sitting at a poker table. So ask yourself this question. If Donald Trump is offering specific tax incentives to a narrow group, such as hourly workers who put in a lot of overtime, and he's offering something to them, why would he do that? I mean, one could say J.D. Vance, his running mate, is, from a working class background. He knows that world, and so, he's trying to do something for them. Now, that's a positive way to think about it. Another way to think about it, of course, is that maybe he feels like he needs to bolster his support amongst that group. And if you do need to bolster your support amongst that group, and you're throwing out things that, might be a little out there, at least from a historical perspective. If you're a Reagan Republican, it probably doesn't resonate with you. Then that suggests that they have a hole in the boat and they're trying to figure out a way to plug it. So those are other things just to think about. Defensive stocks and good quality. I'm just going to, Rymoka is asking, like tea and Coca-Cola. Thoughts? Defensive stocks and, quote, good quality. So that good quality thing, I don't know. Now, I've owned AT&T in the past, and I had it for some period of time, and then I got that WBD stub, the Warner Brothers Discovery stub, when they did that little spinoff. That was not so terrific. So let's just take a look at T. So the first problem I have with T is that they still have some legacy wireline businesses that are capital intensive and struggling. In South America, for example, if you had a wireline business and you're still trying to maintain that, and this is just an example, but wireline businesses are continuously on the decline, which is what we would expect. Fewer and fewer people have a conventional home telephone. Fewer and fewer businesses do. We use a VoIP phone, a voice over internet protocol phone. I am pretty sure on the sell side trading desks they cannot do that. But I'm guessing that a lot of other businesses that don't have the same kind of regulatory constraints and don't have the same need for redundancy and robustness, that a lot of them are probably looking to cut that because the costs go way down, right? So it's an important aspect. And that's one of the reasons why, as if you're looking at my screen right now, you will see that the top line growth for AT&T, despite the fact that there's always more and more mobile phones out there, that their revenue growth is not even keeping pace with inflation or with GDP growth, either one, right? And as many of you will know, and as I've frequently said, that's kind of my benchmark, right? Because if you are not keeping up with inflation and you are not keeping up with GDP growth, then that business, by definition, is relatively shrinking. In real terms, it's shrinking. Nominally, it might be flat, but in real terms, it's shrinking because $120 billion today is not the same as $120 billion 5 years ago. And the other thing that concerns me a little bit is when I start to see any wobbliness in free cash flow. So we can see that a little bit. Trailing 12 months, $21 billion in free cash flow, $20 billion for the full year 2023, ended December 31st, and the forecast for full year free cash flow this year is $17.5 billion. So that is year on year, you're dealing with a sequential decline of about $3 billion. $3 billion over $20 billion, you could say, okay, so 15%, maybe that's not that big a deal. I would suggest, though, that if you take a look, and let me see if, can you see my cursor moving around? You can. Okay, good. So here's your market capitalization, and it's $155 billion. Here's your enterprise value, $316 billion. One minus the other gives us our net cash. And if it's a negative number, that's your net debt. All right? So that's $160 billion. $160 billion in net debt. Then $160 billion in net debt versus that kind of free cash is a little bit more troubling. So you stack on that a big chunky dividend, and it's a stable business, but it is a business that, it can get a little bit wobbly. Oops, what happened? That's not what I was trying to do. This should come up with, let's take a look here. Okay, so here we have the dividends, the historical dividends. And this is actually the forward-looking dividends. Let's go back in time. Sorry, I want to look at the historical ones first. And, if you were a shareholder, you were getting 50 cents a share in dividends previously. Then you got that spinoff because of Warner Brothers, which was terrible. Not alone in being terrible, but it was just horrible. I remember getting it. It was an odd lot stub, and I had the stock sitting there, and I remember thinking, okay, I'm going to take a good look at this a little bit later, and I, turn around. Basically, as soon as the spinoff took place, it just went basically straight down at a 45-degree angle. So does that mean that I think AT&T is going out of business? Do I think that they're not going to be able to support their dividend, as the CEO, whoever the CEO is, will say every single spring at Pebble Beach, which is where they hold the AT&T Pro-Am, their cash flow covers their dividend. Yeah, I get it. So it's just a point I would make. Is it a good company? I don't know about a good company. Is it an okay company? Yes, I think it's an okay company. And I would actually say that, it's kind of an interesting situation for companies like, so defensive stocks, I think, so I'm getting someone in my ear saying he wasn't just asking about that, defensive stocks in general. I do like them. They have performed well. You can see that if you look at staples, and you can see that if you look at utilities. And by the way, on the utilities front, there was news on this that somebody was, let's see if I can find that. It was if I can find it, was it Oracle? So I think Brian Sullivan, I don't know, I'm going to just, this is a question for the people who are producing the show. Are we able to pull up any tweets? Because if we can pull up tweets, that might, look for one from Brian Sullivan. He was just talking about a contract on a massive amount of, see if we can find that story and just share that. The utility trade, it would seem, does remain intact because the demand is there. You know, the demand for energy to support all of these server farms for AI, and just, you know, the fact that, you know, the population grows, and as long as the economy, so you have, you know, at least some stability in industrial demand for power remains there, then that's sort of the reason that's created some outperformance. So that's a defensive stock. Defense stocks themselves, Lockheed, things like that. I exclude Boeing because Boeing has got its own sort of set of problems, even though it's a huge defensive stock, but I'm just not all that enamored with what management has been doing over there. And they continue to seem to have some problems. But defense stocks, I continue to believe, are defensive. And so I like those. And staples, I think, which is kind of what you're referring to with a name like Coke. And by the way, I have Coke up here, Coca-Cola. Slightly better growth other than this year, year on year. They are keeping up with GDP growth, or so it would seem on the top line. EPS growth growing at least as fast and arguably a little bit faster. That's often because of corporate actions, right? So yeah, and we're going to see whether one of the guys can pull up that Brian Sullivan tweet. I think it's his. Yes, there was one about power, so we'll see if we can get that. So yeah, it was Oracle's contract to, and I don't remember. It was some massive amount that they were contracting for. So if we take a look at XLP, by the way, which is the Staples ETF, and so we can just take a look at the constituents of it. This, by the way, is not a bad idea also, is that you can go into something like the Staples ETF and then try to pick out some of the names you like best, and also try to identify where some of the problem spots are. So what are some of the problem spots for me inside of XLP, the ETF? The first one is Costco. Love the company, hate the valuation. And the thing is, I made this comment to somebody about 4 weeks ago, and their response was, oh, but Costco always trades at a high valuation, as if that's a rationale. But actually, while the valuation has always been rich, it has gotten much richer. Okay, and Costco is one of the largest constituent stocks, so you can't ignore it. It's about 14% of the XLP ETF. So what I like to do is go in here and say, okay, here are some of the names that I like in that. We just looked at one, which is Coke, which is sort of, you know, growing at a decent pace. Walmart, which has been doing reasonably well and has been doing well on the B2C side. They, and of course, is always supported by the fact that the family owns about half that company, and they never seem to sell any of it. And in fact, often want this company buying back the shares. So essentially, as that happens, it's accretive for them, and they end up owning an ever larger percentage. But Costco is one spot that I'm a little bit concerned about and might steer away from. And not necessarily a bad company and one to steer away from, but one just to be aware of, is that, but these are much smaller constituents, are names like Kroger's and so on. Kroger is actually a name that I liked. I thought its valuation was quite cheap. They are dealing with the antitrust issues related to their acquisition of Albertsons, and they actually have caught a bit of a bid here. Stock has actually done okay, as you can see. This is a 5-year chart, but it's still not massively expensive. So I think these are fine stocks in terms of defensive things to own. But you can buy XLP, but just be aware that if you do, you got that Costco thing, and I'm not that crazy about that. Okay, so talking about utilities, why are they sensitive to rates? Any dividend play is going to be sensitive to rates because they're an alternative to other forms of fixed income. But that relationship will start to break down when rates get really extreme. Not that we're going to get anywhere extreme. We're not going to go to the kinds of rates that we saw in 1980-81 timeframe, which is going to throw things all over. But the real story for the utilities, electric generating utilities, is that the assumption is that the demand is going to go much higher. And we haven't historically, people haven't thought about electric generation as an exciting growth business. But it is a growth business. And if you were wondering why, consider this. I give you two things: electric vehicles, artificial intelligence, and Bitcoin mining. I mean, but Bitcoin mining is pretty portable, so it's a little bit different. And that's why, the Bitcoin miners are always trying to hunt around for the cheapest power. But I will just say this, these are huge growth markets where the demand for electric power is going up. Now, the sources of that remain to be determined, but the fact that you've got businesses that are talking about creating small nuclear power plants themselves to meet their power demands suggests just how big that is. And imagine that someday the vehicle fleet is going to be much more electric than it is right now. And you begin to understand just how big the scale of this is. It's not a small thing. So those are the two things about utilities that you can think about, is that generally speaking, they are a yield play. Comms too, right? So communication stocks, like we were just talking about, like AT&T and Verizon to a degree, those types of things. So that's, so Tucker D. Dog says utilities also have high capital costs requiring big debt. This is true. Of course, they do have big capital costs. They also are regulated entities, though. So, they basically are going to get some, in many places are regulated. It's a little bit of a morass. We've had some markets that have, and stumbled doing so, been a little bit deregulated. But my point is that when it comes to the electric utilities, how much they can charge is partially restricted, but it's going to incorporate some of their costs. So you basically say, here's what we want to charge, and like that. It's not a completely free market. But in the grand scheme of things, just consider that the market for electricity is going to grow, and it's going to grow a lot. And that is a big tailwind for it. So I am not too crazy either. Too expensive compared to the valuation. So that's this. Let's just take a look. I'm just going to put it in here. This is what we've seen in this area in utilities, especially this big recent run-up. So let's just take a look at what it's done. This is not what you would normally expect to see, right? Utilities, people don't think of utilities as being up 44% over the course of 1 year. That's what we're dealing with. That's extraordinary. But I think I just spelled out the reasons why we're seeing that. And I'm offering a much longer chart here so you can put this into a bigger context, which I think is also important. And the other thing is that, of course, because you do want to give some thought to total returns, because these things do, in addition, pay a dividend. So if we compare it to just say the broad market over time, you can see that the total return versus the price change for the utilities since 2019, this is 5 years I'm going back here on this chart right now, that more than half of the total returns, or actually, I'm sorry, about half of the total returns, 22% or thereabouts, came from dividends. Much smaller percentage in the course of the returns on the S&P over the same time frame, right? So I think that still remains intact. Okay. Can you speak about Netflix sell puts at a conservative price into earnings on October 18th? I really like Netflix. And actually, this is kind of interesting. So Netflix, I think of Netflix as an unregulated utility. And the reason for that is, and I'm sure most of you watching have Netflix subscriptions. And imagine getting rid of your Netflix subscription. If your household is anything like mine, that's not easy to do. I think when the streaming wars really got started, you had Paramount Plus, you had Disney Plus, all these different sources, and you figured that's just going to keep a lid on things, and it's going to be all about content. Well, first of all, they're generating content, and people like their content, and once they do, that sort of locks them into that ecosystem. They don't charge that much, and they have gotten a little bit more disciplined about making sure that they are charging people. So they've cut down on things like user sharing. They have not been all that flexible about their pricing plans, which I think they could be, arguably, if they really wanted to optimize how much they're going to charge. FinWest, I've never been a Netflix subscriber. I would love to see, by a show of hands, how many people who are watching right now are not subscribers and how many are, and just do a quick poll. My guess is that a lot of people are Netflix subscribers. So I'm just hearing that one of the producers is also not a subscriber. Let it go a year ago. I think that they have a very good business. And, this is one of those things. I have that thing called the Holly Index. But what I mean by it is that I have a tendency to favor companies whose products we like, we enjoy, we use, and have a hard time imagining getting rid of. And by the way, that includes Costco, but there's that valuation thing. But here's the thing. Take a look at the EPS growth, right? So even if it's growing 20% year on year, which is the forecast for next year, and, so that gets us to, let me get rid of this. So we're trading, 35 times earnings and growing at, low-ish double digits, but double digits. So subscriber. Yeah, so far I've got, all right, so it's about 60% in the pro subscriber camp, but it's a very small sample size. So conservative puts. And the other thing is that actually, if you're going to be a put seller, you should be able to get a decent implied vol for it. And sure enough, look at that, better than 30%. So let's just pull it up on the Options Play app. And see what we've got. Okay. So they're going to be reporting on the 17th. You can also sell put spreads, but like I said, I think the downside here is limited. There is this unfilled gap. That's the one thing, and we are, getting into that neighborhood. So that's the only thing that actually that should have been filled. That's stale, so that's not a problem. Actually, that did get filled. Okay, the average move on earnings about 9.5%. Right now, it's implying about 7.5%. And if you're wondering about the 7.5% implied move calculation, it's a little different when you start looking further out in time. The way you calculate the implied move is by taking a look at you take a look at two events that capture, two expirations that capture the event, and then you compare the volatilities between them. And then you can calculate the one-day implied move based on that difference, which is a little different than we usually do it when you're just saying, oh, well, how much is Toll Brothers, for example, or Lennar, which is going to be reporting, or FedEx. FedEx is going to be reporting tomorrow. Implied move of about 7.4%. And you can calculate that simply by taking a look at the options that expire on Friday. You can just take a look at the straddle, see how much the straddle is, and then you look and you say, okay, well, over the last 8 quarters, it's moved about 6.8%, so that's in line, right? When you go further out in time, like we're looking at Netflix, 30 days out, the math is a little bit more complicated, but I'll just tell you what the number is, 9.5%, which suggests that the near-dated options aren't so expensive. So it's not like they're just handing out free money to sell these things. But you know, you want to find a level of support and start selling at that level, bearing in mind that generally speaking, I like to make sure that you're getting a decent yield. This is November. I don't want to go out quite that far. So if I sold the 18th, that's actually going to be right on the earnings number. But the 660s, so that's where there is some support. We have an implied move of, I said 9.5. Let's just round it up and call it 10. So that means, you know, maybe down to, so the risk range, if you will, 10% higher or lower. That gets you down to about 620. So if you sold a 660 put and you're collecting almost 20 bucks for that, you know, you can think about that on a standstill yield basis, right? So you're getting almost $20 over the risk. So the risk is where you would own it in this case, which is 660. So 3% over the course of 1 month, 36% annualized, not bad. Downside is that you would own it at 660 less the 20 bucks you collect, which is 640, which is, you know, a decent discount, right? It's going to be a $50 discount to the current stock price, 7.2% lower, not terrible. But you are selling into the earnings print, which is a little bit more of a challenge. So one of the things you can do is, you know, you can calendar this thing out and, you know, do something like a strangle swap like I've previously recommended in some other stocks. I would try to capture the ticklish bit if you do a strangle swap. So buying some, let's say normally we would go out to January and then sell, you know, the October, so Ocjan. But I don't know that the January expiration is going to capture January's earnings date, which at the estimate for that right now is January 23rd. January expiration is the 17th. And if we take a look at what the options market is implying in terms of when that event is supposed to take place, we'll see it in the term structure. And yeah, so you'd have to go out to February. So it would probably need to be a February trade. And if you're going to go out to February, so sell Oct, buy Feb. And do we want to take 10%? My problem, they crashed the last 2 times on earnings, came all the way back. So this would be a way to profit on the move in either direction. James Forbin. The last time I subscribed to Netflix was when they mailed out discs in little red envelopes. We've come a long way since then, haven't they? By the way, I have to... It's going to be a story for another time if anybody's interested, but one of the biggest shorts I ever helped somebody put on was in Netflix. It was a... I don't know how much... I won't share too much about it right now. If anybody's interested, I'll tell the story. But it was a 9-figure... almost 9 figures, I guess. It's probably, I'll have to do the math. I think it was close to 9 figures, though, how much the trader made on that bet. And then they closed it out, never to be harmed again. So, anyway, the options edge, order date August. Oh, I don't know, did I tell the story about it in the options edge? You've always mentioned that. I may have. So, PC, I'll tell you what. We'll keep that one for another day because I have kept you guys for more than an hour already, and I always appreciate your time and your patience. It is a good story, and I will tell it. It's quite incredible. So please like, subscribe, and if you want to hear about the big Netflix short, I'll tell that tale on one of the next ones. You know, was there one last question? Do you guys want me to take one last question? Market hour shows. Yeah, we will also try to get one of those things in. For that, you're going to have to sign up, hit the notification bell, because if I see some breaking news that I think deserves to be told, and the rest of the gang can circle up to do it, then we might just turn the camera on and start talking about it on the fly, time permitting. So make sure to hit the notification bell, and if there's an event that you guys are looking at that you'd really like me to talk about before, during, after, highlight it. Maybe we'll try to schedule a live stream for that one as well. All of you guys who tuned in, thank you as always for watching, and I look forward to joining you guys in the next one. Regularly scheduled is going to be on Monday at 4:15 Eastern Time. I'll see you here.